Welcome back to the Retire in BC podcast. I'm Ben, as always, joined by Arnold. And today we're diving into a pretty deep topic, just investing in general. We're going to try to explain the fundamentals in an easy way to simplify the topic and get you on the path to a successful investment journey.
Yeah, so far we've talked about how big your retirement nest egg needs to be. And we touched on the idea of having your nest egg in an investment portfolio, but we haven't really described what investing actually is. So, put simply, investing is just making your money work for you. We're going to explore that concept more deeply, chat about some of the investment vehicles that are out there in this episode, investments like stocks and bonds.
Well, yeah, exactly. And so investing really, like Arnold said, it is just making your money work for you. So if I go to work and I earn $100, that's working. That's me trading my time for money. That's not investing. If I take that $100 and I put it into something that I think is going to earn money for me, my money's going to earn money, that's investing.
Unless you're going to Vegas, then maybe it's not investing. You might think you're going to make money, but yeah, I mean, this is a topic that's so broad. Frankly, we could probably have a few podcasts on it, but we're going to try to simplify it and do it in just this one.
Yeah, well, exactly, and you make a good point there too. With like, you could go to the casino and if you think you're going to earn money, it's for those people too, though, like depending on how much of your time it takes, even if that does have an expected return, that could still be considered working, not investing.
A good point.
And same thing with like being a landlord. It's kind of this mix of investing in something. You think that renting out the house is going to earn you money, but there is a component of work to it. So these are topics that blend together a little bit. But yeah, basically we'll get into investing, try to isolate that as much as possible and just talk about that. And then maybe at the end too, we'll wrap up a little bit of those lines, how they blend together.
You know, when you think about it, actually, that concept follows through even with stock ownership. If you just buy a stock and hold on to it, that's investing. But some people turn that into a job and spend their whole day trading or whatever it is. Again, that's something that might, depending, be considered not investing. It might be gambling, it might be a job, or maybe it is investing. It depends on how you're doing it, really, quite a bit at the end of the day. So we're going to talk about risk and reward. Investing is fundamentally about balancing the risk with the potential reward. Can't say it's strong enough. It's probably the most fundamental aspect of investing. You can lend your money to somebody and expect a low rate of return, or you can buy something that you're convinced is going to go up in value and get a high rate of return, but the risk and the reward are generally going to be commensurate.
Oh, well, exactly. And that's something that I too, like, I think that's the most fundamental piece in terms of what investing is just balancing that risk versus return. And we're going to talk about how that filters into a portfolio in a little bit, in the way that you put stocks and bonds in a portfolio. But before we get into that, I really wanted to just run through an example and solidify for people, make it a little bit more intuitive, this concept of there being a risk versus return trade-off. So I want you, our viewer, to imagine I have some financial product. It costs $1,000 and it's going to pay you $200 a year. And so that's a 20% return. That sounds great, right? Are you going to buy it? You might or might not. What we haven't talked about is who's giving you that product. So let's go into a little bit more detail here. What if the person offering you this 20% return is some shady guy in an alley? And he says, oh, yeah, give me $1,000 today, and we'll meet back here 1 year from now, and you're going to get $200, and we're going to do that year after year after year, and eventually you'll get your $1,000 back.
I don't think I would take that deal.
I hope not, right? And I hope most people wouldn't. But now contrast that, and let's say it's offered by someone really reputable, a big bank, a government, something like that, and they say, "Oh yeah, we're going to give you $200. We're going to give you a 20% return." Suddenly you do take the deal. And so the same potential return here, the same 20% return on the table, depending on who's offering it to you, you might take or you might not. So basically, with the example of the shady guy in the alley, it's too risky for you. Whereas with the bank, there's less risk, and so you're willing to take it on, right? And so with the bank, in fact, not only are you willing to take on 20%, if you take that investment, I might come up to you and I might offer you $2,000 for that same investment that pays me $200 a year, because that's still a 10% return. I'm still quite happy with that. Someone might turn around and buy it from me for 4,000, and that's still $200 on a 4,000 investment. That's still paying them 5% if it's guaranteed by the bank and it's risk free. So what's happened here is that basically the absence of risk has driven the price of the product up, and because it costs more, basically the yield has gone down or the potential return has gone down on that investment.
So the kind of risk that Ben's talking about there is something that in our industry, we refer to that as counterparty risk. That there's a risk to who's going to give you that money. Uh, Probably the most common type of risk that we talk about, though, because risk means different things to different people. The most common risk that we talk about in the industry is volatility. It's just the function of the price of whatever you're going to buy going up and down in value. And there's an analogy I like to use because it's often a mistake to focus too much on volatility. Volatility is there, you got to be aware of it. But if you think of a guy with a yo-yo, and the yo-yo's going up and down, and you see that, and you focus on that yo-yo, and you look at it going up and down. If you buy good, solid, big companies, what you've got is that yo-yo going up and down, but it's on a person walking up a hill. So if you take a few steps back and you look at the person, seeing the yo-yo going up and down, but also this upward trend from the person walking up the hill, then the volatility is not so bad because you've got this upward bias.
Yeah. But I mean, day to day, people don't like the ups and downs. But you're right, over the long haul, if you're climbing on a hike up a mountain, you're not so concerned with the daily ups and downs and the weekly ups and
You're
downs. And
you're focused on the end game, right? And that makes it easier to handle sometimes that volatility.
yeah. Well, and so in the example with the bank here, if the absence of volatility and the absence of counterparty risk, just the absence of risk in general, is causing me and everybody else to accept a lower return, the absence of risk is lowering the return that you get. And the opposite or the reverse of that is also true. So if you go from that to another investment that does have some of these types of risk, you have to compensate me to take those risks. And the way that you compensate me is by increasing the expected return that I'm going to get. I'm going to say, you know what? I don't care so much about the ups and downs in the yo-yo. And so basically, I'm willing to accept that risk and climb the mountain. Someone else might say, you know what? I don't want to climb a mountain. I don't want the yo-yo. Keep me on solid ground, and basically lower risk, lower return, or lower potential return. Um, I shouldn't use potential return. I should use expected return
Right, right.
in these cases.
And so really, in simple terms, you're saying in general, it's true. The riskier something is, the more money you're going to get paid for it. And the less risky it is, the less money you're going to get paid in general. And that's sometimes mispriced. And that's where sometimes we can take advantage of mispricings. But in general, that concept holds true. And I guess there's understanding that backdrop, there's two core investments that in our industry we work with, stocks and bonds or equities and fixed income. It's not exactly synonymous, but we use those inter we use those terms interchangeably, stocks and equities, and then bonds and fixed income. A stock represents ownership in a company. It can feel a little bit, what's the word that I want? Ethereal. It can feel like not real when you own shares, but you know, it really is like you own a piece of the brick that the bank is when you own those shares. I know Warren Buffett, who many people know, likes to view every single share that he buys as though he's buying the whole company. He's only getting a piece of it when he just buys shares, but he likes to view it as though he's buying the whole business. And I find personally, it's easier to think in terms of owning a business or a piece of a business than it is to think of this piece of paper that's a share. But that piece of paper represents a piece of that business.
Well, yeah, exactly. And it's exactly as you say, I prefer to think of it as owning a company because it makes it feel a little bit better when you do go through that volatility. If I own 100 stocks or 100 shares of stock XYZ, and today it's worth some portion of money, and a year from now it's down 20%, I still own 100 shares of XYZ. I still own the same proportion, assuming they haven't issued new shares or whatever, but I own the same proportion of the same company that is still going to go out and hopefully earn a return. Just because the market has valued it differently today versus they did yesterday doesn't necessarily mean that the actual value or inherent value in the company has changed. It's something that just because it's traded daily, because people's sentiments change, the price can change pretty dramatically, whether or not the actual fundamentals of the business have changed.
It's
Um,
possible that you made a mistake. It's a good time to reevaluate.
yes, yeah,
But I agree 100% that often when that happens, it's a better time to buy more,
yeah, yeah.
you know?
Well, and
Yeah.
and the other reason I like to think about it as a business is because it's too easy to get swept up in, oh, I have this portfolio of stocks and the price is changing all the time. Where is the actual value or what's actually happening? When you think of it as a whole bunch of different companies, well, each of those companies is in business to earn a profit, and you are a part owner of that business, and so part of that profit belongs to you, right?
Well,
As
and part of that profit often usually gets paid to you in the form of a dividend. So you actually do, not always, but because not all companies pay dividends, but many of them do. And so part of that profit you actually get in actual cash or a deposit into your bank account or a deposit into your investment account. And then, yeah, the other part is they take that same profit and reinvest it in the business so that your shares can or that their profits can grow and theoretically then the value of your shares also grows.
Yeah, so as it relates to what we were talking about before with a risk return trade-off, stocks in general, we would classify in more towards that riskier side of the coin. They are more volatile and they are also higher potential growth than some of the other stuff we'll talk about in a bit. But basically, stock ownership, that would be a primary driver of long-term wealth creation. And like we said, those stock prices, they fluctuate daily or well, by the second, really, due to lots of things, whether it's the actual fundamentals of the company, broadly speaking, the economic situation that we're in, but also just due to market sentiment, like we talked about before. Sometimes the market is just up today for seemingly no reason, or vice versa, the market falls quite a bit. Is the actual value of what you hold different? Maybe, maybe not. That's kind of an academic discussion we could have about whether markets might be overly volatile. But yeah,
Actually,
basically, yeah, go ahead.
I love the analogy that was used by a guy called Benjamin Graham. I mentioned Warren Buffett earlier. Actually, Warren Buffett studied under Benjamin Graham and started off using Benjamin Graham's philosophies of value investing. And Benjamin Graham wrote a fantastic book. Actually, he wrote a couple, but one is called The Intelligent Investor. And for anybody interested in doing stocks on your own, I think this is a must read. It just talks about valuing companies, but he uses this analogy of a company or a stock being like two partners in a business. And one partner is a very stable individual, and the other one is manic depressive. And so that stable individual knows that their business is worth a couple of $1 million, a million apiece. And it's just based on how well the company's doing. He's valued it, and he knows that another reasonable business owner would pay $1 million for his share of the business. But the manic depressive partner, when interest rate rises, he freaks out and he says, "This is terrible. I can't handle this. Will you buy my share of the business for $700,000?" All of a sudden, the value has dropped by 30%. Well, it didn't really. It's just he reacted. And he's the market, the stock market, because it's a bunch of investors that are reactive. But then they get a new customer, and all of a sudden he becomes manic and says, "This is fantastic. Can I buy your share for 1.3 million?" And so knowing the value again helps you accept that volatility. Uh, and we try to use managers and try to do it ourselves to value companies and understand what they're worth and buy them when we can pay less for them. Anyhow, that's a lot about equities. We could go into it a lot more, but really, at the end of the day, it's good to know that stocks fall into that category of the higher risk, higher volatility. But even there's a spectrum. Some are far less risky, far more stable. The widows and orphans stocks, we refer to them, are the blue chips, and others are definitely very risky.
Yeah, well, and touching on the Benjamin Graham stuff, because I've been looking into that too. Actually, right now, I'm reading Charlie Munger's book,
Yeah.
Warren Buffett's former right-hand man before he passed. But yeah, and he also yeah, idolized Benjamin Graham, and Benjamin Graham is the father of value investing. Basically, um, he actually personifies this person and calls it Mr. Market.
Right.
Is the
Yes,
other
that's right.
that's the manic depressive side of the market. That's one day he's bipolar. So one day he's offering you this great
Is,
valuation on
isn't
your
isn't
company.
manic depressive bipolar? Isn't that what that means?
I'm not 100%
Have I got
sure.
that wrong? I don't know. I'm not a psychologist.
Yeah, me neither. Me neither. But the other key point he makes about Mr. Market is that he only ever offers you a deal. You never are forced to
You're not
take it.
forced to take it. Yeah.
Exactly. Yeah. So your business that's worth his half is worth 1 million. One day he offers it to you for 700,000. The next day he offers it to you for 1.3 million. It's up to you whether you take that deal or not. And that's a pretty powerful message actually. It puts more of the agency into your hands. Yes, he's altering the value of the company by doing so, but if you're a savvy investor, you can make out pretty well from something like that.
Which we hope we all are. Yeah.
Yeah, yeah. So as Arnold said, that's one side of the equation. Stocks as a whole are higher volatility, um, higher risk, I'll put in air quotes, and higher potential for return. The other thing we can introduce into a portfolio, or one of the other things on the other side to try to tame some of that volatility, would be fixed income or bonds. So basically, bonds are just a loan to a government or to a corporation in exchange for a particular yield that they're going to give. And eventually you're going to get your principal money back as well. So for example, a company might offer you a 5-year bond that pays 4% per year. So you're contractually going to get 4% in cash returned to you every year. And then at the end of the period, you're going to get all of your capital back.
Actually, this is a really good point, or point in time to reintroduce that concept of counterparty risk, because you might have that same bond guaranteed by the government and the risk is super low, You may have it guaranteed by a bank, and the risk is also quite low, but not quite as low as with the government. Or it may be with the corner store down the street, and the risk is pretty darn high. And again, there you're going to demand a higher return when the risk is higher, and that's exactly how bonds work.
Yeah, and there's a bit more to it than that. I don't know that we need to get too in depth into it, but there are parties out there that will rate companies based on their
Right.
balance sheet, sort these bonds into investment grade or high yield. They'll give them, oh, this one's AAA and that one's a C rated bond or whatever. Even then, within those bond issuances, then sometimes you'll have senior secured debt, meaning that it's secured against some of the company's assets. You can have unsecured bonds. There's a whole host of different levers that you can pull within the bond universe, but we're just trying to establish as a whole, bonds typically are lower risk. Even within that space, there's going to be a range here where, again, the riskier the bond is, the more you get compensated for taking it on. Basically, by definition, that's going to be
Well,
true.
and the bond universe is so massive. The market is so massive that they are very tradable, very liquid. Even though you have this in the example of a 5-year bond, this 5-year commitment, that bond deal is the same with whoever is lending out the money, or sorry, whoever is borrowing the money. But you can sell it to a third party in a heartbeat. So it's a lot like a GIC. You know what you're going to get. You know the interest rate you're going to get. You know the principal you're going to get at the end, but it's tradable. Being tradable means that prices can fluctuate. And that's a complicated calculus. I don't think we're going to get into that here, how that works. Although, I don't know, actually, maybe we do want to talk a little bit about how the negative correlation to interest rates. I don't know, Ben, should we talk about that for a minute?
I suppose we can.
We didn't
Sure,
throw
yeah,
it on the
we've brought it
agenda,
up, so
but
let's do it.
yeah, we didn't throw it on the agenda, but we don't follow an agenda very closely here, but we do have a bit of one. But when I talk to clients about bonds, I use this example, and so imagine me and Ben are business owners, and I need to borrow $1 million, and Ben's really wealthy, and so he says, you know what? Arnold, I'm going to take that $1 million. I'll take you on that. So I'm offering, let's go with 4%. And I want to borrow that money for 5 years. So we have this deal. I issue a bond. Ben buys that bond, and I have this promise as part of that bond to pay him 2% every 6 months. That's some bonds pay quarterly, some pay annually. The most common is every 6 months. And so we have this deal. But you know, a year down the road, Ben's thinking, oh, you know what? I'd really like my $1 million. If he comes to me and says, I want my $1 million back, I'm going to say, no way. Our deal was I get to borrow that money for 5 years. That's what we said, right? But there's this broad universe out there of people that might buy it. Well, his deal with me is 4%. Just imagine interest rates now have fallen to 3%. Am I paying any less? No, I'm not. The deal we had was for 4%. He's getting 4%, but the market rate is only 3. So if he goes to sell that to somebody else, the deal is still they're going to get 4%. So because of that, they're going to be willing to pay more for that bond than they might be for another bond that's only paying 3%. And vice versa. If the interest rates go up to 5%, they'll be willing to pay less because they can get 5% elsewhere. So it's a little bit confusing sometimes for people to wrap their heads around. But if you think about it in those terms, it can be helpful to understand it. But at the end of the day, either way, you're continuing to get that interest payment. We call them coupon payments because back in the day, you actually used to cut the coupon out and bring it to the company to get your payment. But it's referred to as a coupon payment. That's the interest payment that you get that twice a year. So anyhow, that's how bonds work in a nutshell. I don't. What do you want to add anything there, Ben?
Well, yeah, I think just what I want to add is that this impacted portfolios not so long ago in a dramatic way,
Good
and
point.
it's
Yeah.
good to help people understand why that happened. So the question here and what I'm referencing is in 2022, why did my conservative portfolio drop in value? I thought it was conservative. I thought bonds had little to no risk. And one of the things we're trying to highlight here is that bonds do have some risk. They can be traded here and there. Um, and they they're subject to market risk in that a little bit Mr. Market is at play and you can value it differently one day than another. They're also subject to interest rate risk. And so that's exactly what Arnold just described. In the example in 2022, what happened? Rates went up pretty dramatically. And so basically, if you had a bond that was paying, let's say, 2%, and let's say Arnold had a bond that had been paying him 2%. And at the time, at the beginning of 2022, I was willing to pay him $1,000 for it. Now, interest rates jump up to 5%. And so Arnold has his bond over here. I was willing to pay him $1,000 for it. But now I could go to the bank and get a new bond paying 5%, also for $1,000. Which one am I going to pick? I'm going to pick the one with the higher interest rate, the 5%, because it's just better for me, flat out.
Plus the counterparty risk would be less.
Yes, exactly. But what am I going to do with Arnold's, or what does Arnold have to do with his 2% bond to entice me to buy it? He has to lower the price. He has to lower the price until the yield is the same to me as the banks, excluding counterparty risk and other things there. But basically, because interest rates have gone up, I can buy this other bond with a higher yield. Arnold has to drop the price to match the yield for me to have these be comparable products. So that's where you have it. There is an inverse correlation with interest rates and bond prices.
Well, and actually to add, hopefully not more confusion to that, if the bond was only out for 1 year, the interest rate loss wouldn't be that great because it's only 1 year. And so the drop on the price wouldn't be that much. But if you had a really long bond, like a 99-year Disney bond, it's going to be a much bigger deal because you're getting less interest for that much longer. And so that got hit even harder in that market. So bonds can be very complicated instruments, but in a nutshell, they are generally less risky investments that we throw into a portfolio to reduce the volatility in a portfolio. So we buy stocks for the return, we buy bonds for the ballast.
Yeah, and note to self: Arnold wants to do an entire episode, apparently, on bond prices and the impact of interest rates and inflation on them. We'll get into the yield curve. We'll talk about duration. Oh,
I don't
it'll
know
be
if we'll
great.
get into all that, but yeah, we'll do something.
Apparently, if you had your way, but no. So that's a couple of other keynotes here. Really, just wanted to talk about the risk versus return trade-off and how that actually makes its way into a portfolio through your asset class selection, through how much you're putting into stocks, the riskier asset, and into bonds, the lower return, lower risk asset classes. Within most portfolios, most investment portfolios are going to have some combination of both. It does happen that you have young people with an entirely equity focused portfolio. That'd be my portfolio is 100% equities, except for money that
Mine
might be
too.
shorter term. And yeah, even many other people, if they're comfortable with the ups and downs, a fully stock portfolio can be appropriate for them. Most portfolios are going to have a little bit of both. And so when we say a more aggressive portfolio, that just means that it will focus more heavily on the stocks or the equities. A more conservative approach is to introduce more bonds, more fixed income.
Well, and I would say also that an all equity portfolio doesn't necessarily have to be considered or doesn't have to necessarily be aggressive. One that was heavily biased towards those widows and orphans, blue chip type stocks. It's certainly more growth oriented than a bond portfolio, but I wouldn't even go so far as to necessarily call that aggressive. It depends a bit, I guess, on your frame of reference. I think it's fair for us to say that pretty much anybody listening to this podcast has a mix of stocks and bonds. If you're eligible for Canada Pension Plan, it owns stocks and bonds on your behalf. If you have a mutual fund, odds are it's got, now it may be very heavy to stocks or it may be very heavy to bonds, but the odds are it has some combination of both. There are some exceptions, and some mutual funds, some pensions also, well, almost all will hold some cash. Some will also hold real estate. There are other alternative investments that they can hold, but the vast, vast, vast majority is stocks and bonds.
Yeah, well, exactly. And I mean, the other thing to note, you touched on it there, is that you can have a mutual fund or something like that, or an ETF. You see one line, but within that one line,
Right. Yeah.
this is an investment portfolio that holds hundreds, thousands of positions, stocks and bonds within it.
Yeah, that's right.
Yeah. So yeah, that's more or less it for this episode. Hopefully, we've helped you understand a little bit more about that trade-off, and hopefully made it just a lot more intuitive, because it is, as we alluded to at the beginning, in my opinion, the most important thing to understand and really drives the behavior in a portfolio. And yeah, hopefully now you understand too how we lever that risk and rewards by using stocks and bonds in a portfolio.
Yeah, and if you're feeling overwhelmed or unsure where to start, don't worry. That's our job. That's what we're here for. The most important step is getting started, and let us help you do that. If you enjoyed today's episode, please share it with a friend, like it, subscribe it. We'll see you next time.
Thanks. Bye. The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken based on the content discussed.